All right. Hello, everyone, and welcome to tonight's training brought to you by REI Pro, your all in one real estate investing software. My name is Bo Manry, and my business partner is Chris Goff, and we're the founders of REI Pro. Now, tonight it's all about analyzing seller finance deals. We'll show you how to find these deals and how to market them, but most importantly, we're going to show you how to run comps and create offers.
So, seller financing, also known as owner financing. So, to me, these are the exact same things, is a unique method of a real estate transaction where the seller of the property also acts as the lender. Instead of the buyer securing a traditional mortgage from a bank or other financial institution, they essentially borrow the money directly from the seller to purchase the house. Now, the seller isn't writing the buyer a check for the buyer to give the seller back the check. So just keep that in mind. This is all done through paperwork. So many benefits to doing this. Now, you may be one of those sellers as a real estate investor. You may have bought a property and maybe one of your exit strategies is to seller finance it back out. This is also great for you to acquire property at the same time. So, this strategy is going to use to acquire it as well as being a very great exit strategy. I want you to think about, why do the banks have the tallest buildings wherever you go? It's all that interest they're making off the financing side of it. And that's essentially where you can make so much money over a longer period of time. You don't have to look at real estate as, you get paid one time, either if you're wholesaling or if I fix and flip a house, you get paid one time and then you're unemployed again. You got to go do that over and over and over again. Where seller financing is a great way to have multiple different profit centers coming in each month. That's just a quick overview. Like I said, we have detailed instruction on this, but I want to talk more about why this is such a crucial strategy. Like, this is so important for real estate investors. Number one is just an alternate financing option, right? So, like traditional lenders or banks, they often have strict and may not even approve the loans for certain types of properties or borrowers. I want you to keep that in mind, with less than perfect credit, right? Seller financing can also provide this alternative way to finance the purchase, opening up opportunities that might not otherwise be inaccessible. Next is really the flexibility. Okay, so seller financing deals are typically more flexible than traditional bank loans. The interest rate, the repayment schedule, other terms, because we actually negotiate that between, if we're the buyer, we negotiate the terms with the seller. If you're the seller, you negotiate those terms with the buyer. And it's going to allow both parties to reach an agreement that suits both of their needs. Now, faster closing process. Because you're not dealing with a traditional lender, the closing process can be much faster. This is particularly beneficial in hot real estate markets where properties sell quickly. I can tell you, anytime if you get traditional financing, everything's always contingent on financing, right? The sellers hate this part. Potential for better returns. And so, as a seller, providing financing that could allow you to sell your property at a higher price and earn interest on the loan, potentially leading to better returns than just selling outright. So, if you don't need the cash all up front, you want to use this as more of a, maybe a 5 or 10 year investment deal. This is where seller financing can really make you a lot more return on that particular investment. It's obviously going to attract more buyers, right? So, offering seller financing can make a property more appealing, especially those who struggle to secure traditional financing. So, this can also help sellers sell their properties faster, and especially with higher interest rates. If we can negotiate the terms better, it would actually be smarter to do the seller financing than it would to go to a traditional bank today. Okay. Now, we're not talking about buyers that have no chance in the world to ever cash you out. Okay. So we always like to get with mortgage brokers and build a plan with our buyers, no matter if it's seller financing or lease options, it's going to be the exact same thing. Let's talk about the types of seller financing deals. And I know a lot of people get a little confused over this. Okay. So I want to just talk about Some of the common ones and then some less common ones. So, one of the common ones, this was really used a long time ago. It's called a land contract, also known as a contract for deed. So, this is an agreement that allows buyers to use and occupy the property, but the seller retains the legal title until the full payment is made. I want you to think about this like a car. If you get financing on a car, you don't actually get title to it until you pay it off. So, this is another way. It's not lease option. Okay. Lease option could be considered this the way that I phrased that. But the way we structure a land contract, there's going to be a purchase price, an interest rate, monthly payment, there's taxes, insurance, and all of that good stuff. The buyer is actually building equity in the property, but if something goes wrong and the buyer leaves, they don't have legal title to the house. So this is not very favorable in a court system anymore, but a lot of people do it. So as you, the seller, if you're the seller and you seller finance it, you really don't want to give the deed to anyone, right? And that's where you're going to find more sellers wanting to do a land contract. But if you're the buyer, you want the deed. Okay. So again, this is kind of an old school way of doing it. It's still being done today. And that's why I put it in the common category. Next is you probably have heard of this as a wraparound or all inclusive mortgage. So in this scenario, the seller extends the new mortgage to the buyer that encompasses the existing mortgage plus any additional amount for the purchase price less the down payment. So the seller continues to pay the original mortgage and the buyer pays the seller the monthly payment based on those wraparound terms. Okay, so in this particular case, a seller that does this, they want to retain that. I'm still going to pay the bank. I'm going to make, turn this property into an investment and secure their interest a little bit more. The next one is what we call subject to. This is when an investor takes over the balance of the seller's mortgage without qualifying and making payments directly to the bank. In turn, this is what we call taking the property subject to. So, subject to existing financing on the property. You would typically do this in a pre foreclosure situation. Now, though, you could do it with any situation. You're going to find this more with a desperate seller, motivated seller, a highly motivated seller, let's say that. Next is what we call a owner carryback. So this is when the seller carries a second smaller mortgage to bridge the gap between the property's price and the buyer's available cash or loan amount. Now, some less common, and I've got a video on this one, is called subordination. It's not something you would do every day, but you definitely need to check this particular video out. The other one is what we call substitution of collateral. I have done all of these numerous times. Okay. So these to me are a little less common. And I would say the wraparound is going to be in the subject to, or those two are going to probably be the most common types of seller financing that you're going to do out there. All right. So, what are some of the pros and cons? Because there's always pros and cons, right? So, some of the benefits, little to no money down. Keep in mind that we typically work with what you will hear investors call as a motivated seller. You don't have to necessarily be motivated for a seller to do this, right? I mean, they're going to make interest. And when you show the numbers on paper, it's a no-brainer. Low fixed interest rate, we could get in, no bank qualification. Remember, we're not going to a bank begging for a loan and putting down 20%. Now, could a seller ask for 20%? Absolutely, but it's what we agree on. No credit checks. Could a seller ask for a credit check? Absolutely. I could tell you, I've done a lot of these deals and not one time a seller asked to do a credit check on me. Lower closing costs on this. We don't have all that financing paperwork. The best part is it's not going to show up on your credit report. So if you're an investor out there where you've kind of extended your financing, you have to go this route. This is a no-brainer for those people. You can't keep wrapping up bank loans because eventually the bank's just going to cut you off. So you have to use other financing methods to acquire more property. And I know some of you are like, Chris, I'd just like to do my first deal, right? But I'm telling you, it took me 3 months to do my first deal. And I told you I was hooked. I mean, if you didn't want to talk about real estate, don't come talk to me. And although it took me 3 months to do my first deal, I ended up doing 46 by the end of the year. It becomes addictive. It will happen if you just keep applying yourself. So you have to think of that. What is the ultimate goal? Right? Yeah, I get it. Do your first deal, then one turns to two, two turns to 10, and so on. Eventually, you're going to, even if you're wholesaling now, I started wholesaling. Eventually, you're going to have to get into other strategies. Easy to sell to another buyer for all the reasons that I just just told you about. This is the only strategy that we have for profit centers on. So if you sell or finance a property out to a buyer, there are for profit centers here. Okay. So if I sell or finance it to, from a seller and I turn around and sell or finance it back out, there are four potential profit centers. You just don't have one way of making money with the property. And if you go through our full training, you're going to see that all four profit centers, it's pretty awesome. All right, some of the cons, and some of you probably have heard of this. It's what we call a due on sale clause. So that is a paragraph in a mortgage that says if the owner deeds somebody a property without them qualifying for a bank loan, they could call the loan due. That's what it is. So every time somebody goes through foreclosure, that's what a bank is actually doing, is calling the loan due. Okay. This is extremely rare that a bank would call the loan due, especially if payments are on time. What happens if the buyer defaults? Well, if you give them the deed, which is going to be in most cases, you're going to have to go through that foreclosure process. I always use a real estate attorney. They draft up all the paperwork. I even like closing all the deals with a real estate attorney, but it's going to cost you a little bit of money to have that done. And you got to wait for a payoff. So if you're looking for a big payday tomorrow, this really isn't the strategy that you're going to need to do by tomorrow. Okay. When we talk about analyzing deals, I wanted to take it just a couple of steps before that. And that's really about, how do we actually search these deals? What are we looking for? How do we market the deals? How do we talk to people? What's some of those things that you say, or how do you present this, to somebody that's never even heard of this before? And then we really get into the analysis side of running comparable sales. We're going to create a seller finance offer. And then the best part is we're going to determine what is the best exit strategy and look at every financial position of it and see what makes the most sense. But before we jump into REI Pro, I thought I'd share with you just a few lessons that I've learned. I started back in 1999 full time. Okay. So I've learned a lot of stuff. But when it comes to this, it's so important to learn what that marketing message is. Okay. And what I'm talking about is, how do you word things? It could be from a postcard, it could be coming out of your mouth. How do we talk about it? How do we say things in a way that gets somebody to understand what it is you're trying to do? Because I want you to keep in mind, this is not your common strategy out there. The most common thing to do is go to a bank, get a loan, and buy a piece of property. So I want, and as we go through this presentation, we get to what we call step two, talking to the owner. I'm going to share a couple of questions that I want you to ask, and feel free to ask any questions afterwards. I want you to always approach each deal as though you're buying it. I know that sounds funny, but this is what I mean. Don't approach a deal saying, I'm going to go wholesale that. I'm going to go lease option that. I'm going to go seller finance that. I want you to just, I'm looking to buy a property. I want you to keep it that simple with people. As soon as you start directly saying, trust me, this is how I got started. I literally grew up in Northern Virginia, got the Washington Post every Sunday, and I cut out every house for rent in the newspaper. And I called every single one, wondering if they would be interested in doing a lease option. Because heck, if they're renting their property, they're already willing to accept monthly payments. So now it's just a matter of, do they eventually want to sell it? And as soon as I said that to people, people are like, what are you talking about? Is this a scam? Right? People don't understand a lot of the creative financing. So I don't want you to just approach it by just saying, hey, would you do this or you do that? I just want you to go to sellers and say, I'm looking to buy. Now, are there multiple ways that you could do this deal? Absolutely. But don't come across as doing it one way. Pre qualify each seller. And the most important thing, which is not even really talked about anywhere, and I preach this, it's about situation. What is the owner's situation? If we could easily say, are they behind on payments? Are they in pre foreclosure? Are they in divorce? Are they just can't sell? Whatever the reason is, that situation is the most important piece to structuring the correct offer. So many times we think, no, just run the numbers, send it. No, you have to think about, I always call it pet peeves, Bo. Usually a seller their pet peeve is either one of the following. Number one, it's either the sales price. They have to have a high sales price. Number two, it's the down payment. They have to have a high down payment. Number three is the term. How long are they willing to do this for? I always said this, and I want you to always remember this. If the seller picks the terms, you pick the price. And the terms are how much down, how much a month, and how long am I going to do this for? If the seller picks the price, you pick the terms. Okay. If they say, no, I want this for the house or I'm not selling it. Okay, Mr. or Mrs. Seller, I'll give you that under these terms, which would be how much down, how much a month, and how long I'm going to do that for. If the seller picks the price and the terms, they're not motivated because it's not going to be a deal that you can profit from. Real estate investing is about investing in real estate. You have to have a return. Sometimes you don't see that return immediately, but over time you do. Sometimes you need that return to show up immediately. But at the end of the day, it's about getting a return. So we have to run the numbers to make sure that we're going to get the return that we expect. Lead with a cash offer. Unless they just absolutely say, yes, I'll sell or finance it. I can tell you, I live in a multi-million-dollar house, and I asked the owner if he would owner finance this property. He said, absolutely. He picked the price. I picked the terms. That's exactly how it happened. Bo was sitting there on the porch when I had the conversation with the guy. Show the offer on paper, old school paper, or an email. Let them visually see the numbers, because the numbers at the end of the day tell a whole different story. And I'm going to show you how to do that.
Now, we did have one quick question before you go on. They're saying, you said if the seller picks the terms and the buyer should pick the what. And so it's just if the seller picks the term,
If the seller picks the terms, you pick the
then you
price.
pick the price.
Yep. If the seller picks the price, you pick the terms. It's just backwards.
They
We can't have a
both ways.
seller pick both. Hey, because I want $1 million for the house. I want 900,000 down and
20%
I'll give
interest.
you a month to close it. Okay. That's not a deal. Right.
They're not motivated.
No, they pick the price and the terms. And I think that is, I don't even know where I learned that. It's been so long.
No, but
I
that's a
always,
really good quote. It sticks in my mind because, some of the times knowing to walk away from a deal is also part of your learning process. So that's a really good quote to keep in mind.
and especially I think people can relate to this. Nobody has to answer right now, but let me just act like I'm speaking with you.
Mhm.
If Would you agree with me that there are probably a lot of sellers out there, they can't sell right now, okay? But
Mhm.
they expect this one price.
Yep.
They expect this price. And I'm okay with that if I can make that price work. But what happens if I could go to the seller? I'm going to give you the price you want, but I need these terms, and you will actually make more than the price that you're wanting. And you're going to run into a lot of people that they're just stuck on this price. Everyone got into this mentality over the last couple of years where everything was just, skyrocketing after COVID. And now the things are starting to come down a little bit. People still have to sell. This never ends. Like I always say, they don't make any more land and people have to live, right? So real
Mhm.
estate is, and here's the other thing with real estate, everybody goes through a situation. You just need to go find the situations. And that's kind of where we are right now. We need to go find a deal, right? And
Mhm.
that's why we're in Lead Pro. So those of you, if you go to the menu here, we're in this section of the software. And what I want to share with you is I chose Orlando. Here's the thing. When I go look for, if I'm thinking seller financing, there's two lead types that I really like. Number one is absentee owners. The other one is what we call vacant properties. I would target both these. Now, there's always going to be more absentee owners than vacants, no matter where you are. Okay. And we'll filter this list down a little bit. But those of you that we kind of have a preset filter, if you click this button, search by strategy, I can check seller financing and just hit search. We've predefined the best case scenario for seller financing. But I want you to go in and use some filters to begin with. We could say all day long, Bo, like, why would a seller agree to seller financing? I mean, there's so many reasons. Like they
People
can't
ask us
sell,
that all the time.
but it happens every single day, right?
Mhm.
Just in the common things, they can't sell. They don't want to pay capital gains. Maybe they don't need cash up front. It's to prevent foreclosure. It could be divorce, out of town owners, health problems, no equity. Maybe the property needs a bunch of repairs and they can't afford to fix it. Maybe they just got a job transfer and they need to move quickly. Whatever the reason is, it's what I call those situations that you're looking for. You're not looking for everybody to say yes. You couldn't handle the business anyways, right? And here's the good thing, you don't have to do a lot of real estate deals to do well. But when we're in this lead search, and I'm not going through like the whole thing of Lead Pro because there's a lot of cool things here, but I do want to highlight some really popular filters that I would use. You may use something else, and that's fine, but this is just me personally. One of the cool things is you could do what we call stacking. So, what I did here is I said, show me all the absentee owners, but they also must be deemed vacant, is what we call in this business, which comes directly from the post office. But isn't that a great potential opportunity? Because why would somebody have a vacant property? They're paying taxes, paying insurance. Somebody could get hurt on the property. Somebody could vandalize the property. Somebody could take over the property. Yeah, they start living in the property. There's a lot of bad things that could happen. Now, the property types, you could go after any property type. I generally go after single family. That's just what I do. Now, the default filters that we set for seller financing strategy is we take the middle price range and then we go about 100 below and 100 above. So when you look at the estimated values, you can change these. You don't have to go just strictly based on what we're telling you to do here. Okay. So feel free to change the price point. The equity is 100%. Anytime you can do seller financing with a seller that doesn't have an existing mortgage, so easy. Paperwork's easy. It just makes sense. Nobody has to worry about anything. And that's what I like about it. I want to exclude any HELOCs or reverse mortgages. Now, you could go down and really pinpoint bedrooms, bathrooms. You go on the square footage, the year built. A lot of people go to last sold date, maybe more than 2 years that they've owned it. Here's my thing. Like I hear all that, and I've been doing this for a long time. If somebody's in a situation that they have to sell or they need cash, it doesn't matter how long they've owned the house. Doesn't matter if it's a 3 bedroom. If I can structure a deal where the numbers make sense, I know I'm gonna make money with it. But that's just me. That's why I said you might just target 3 bedroom, 2 bath homes. That's totally fine. So feel free to change any of those. Under the owners, I like to do individual owned. And then I don't really care if they live in the state or not, because when somebody goes through a divorce, it's irrelevant. If somebody needs cash, they need to sell, whatever the reason is, it doesn't matter if they live in the state or not. Now, a lot of people would say if they lived out of state, they could potentially be more motivated. And that's true. But if I can get people to understand it's really about situations, this business becomes a lot easier. So we went for, I think it was like 6,000 something,
6,400.
6,400 down to 136. Now, this is extremely manageable. If you pick a large area, obviously the numbers are going to be different, right? And I can go outside this map. One of the cool things you can do here is I'm just within the Orlando boundary. I can actually add in multiple locations up at the search box. I could do all kinds of things. If I hit search by map, I literally can get things that are just appearing on the map. And I could take my draw tool and say, I don't really follow the standard of just going the Orlando boundary line. So there's the ones that I've selected, but the ones in black are, they still meet the criteria that I put in the filters, which is pretty cool. You don't have to just stay within boundaries. All right, so here's what we're going to do without going into too much detail here. The very first thing is we need to market these people. So what I'm going to do is actually build a campaign. I'm going to take all of these leads. I'm going to move them and create a campaign. We'll call it Seller Finance Orlando. You name it, whatever you want to name it. If you do postcards through us, if you do the campaign type, it's going to simplify the selection of postcards that we have to offer. I'm going to add those leads to a campaign. Now, all I do is go back over to marketing, and I'm going to see this right here. Now, obviously, you could click on this. You could pull up details about each property. You could go through those things. I don't do all this research on each individual property that's in a campaign because it already meets my filter criteria of what I'm looking for. Now, you can order postcards, you can print letters. We have numerous letters and templates you can use. You can do bulk skip trace if you go that route as well. But if you do order postcards, the one thing that I wanted to share with you, and it's kind of one of the first lessons that I've learned, I really like number 3 here. So these are our seller finance templates. Now, feel free, you can always upload your own custom template here as well. All right, so what is the goal? Now, the goal is either for the owner of the property, maybe you send them to a website, maybe you put your phone number, something of that nature, right? Because we need to talk to somebody. Somebody gets your marketing material, we need to talk with somebody. So what I did is actually picked out one of these properties that was in this particular list. Now, this Google map is showing a couple of cars here. You can see an individual here, and just doing some basic research, which I'm going to share with you exactly how I do this. This property is currently vacant. Keep in mind, when we filtered these leads down, it has to be an absentee owner and it has to be vacant. So what I did with this property is I just Googled the address. So you can see the address here, 3707 Sedgwick Place, I guess is how you say that. And this property was listed for rent months ago and then removed from the listing. What are some of the most important things from this point? Because we're really talking about analyzing this deal, right? So we have a vacant property, 100% equity. It was rented. They were probably using it as a rental, but now it's being deemed vacant. When do you think they might be interested in maybe selling it or even taking payments on it? Maybe they don't want to worry about the property anymore. Who knows what the reason is? And that's why we market properties to begin with. But one thing I do want to share with you are some of the phone scripts here. Now, I don't want you to read these questions off like, can you tell me about the property? No, you need to have a conversation. And I would go to the vacant script here. So, hi, my name is Chris. I'm calling about a property owned located at 3707 Sedgwick Place. It appeared to be vacant. I was just wondering if you might be interested in selling it. So that's my intro script. Okay, but it's sometimes how you say it too, right? So you might have to practice that. Think about this for a second. There's no for sale sign in the yard. There's no rent sign in the yard. Why would somebody be calling me about a property? A lot of people don't even realize they want to sell until you actually ask them. You want to ease the conversation by starting with this question. Can you tell me a little bit about the property? To me, that's the door open right there. As they talk, this question right here to me is one of the most important questions because this is going to tell me their situation if they haven't already told me. Of course, if they've already told you this, then you don't need to ask this question. May I ask why you're selling? Somebody could say they're selling. Yeah, I'll sell it. May I ask why you're selling? You'd be shocked that you will learn what that situation is. That situation ultimately is going to tell me how to proceed with this property here. And this is where we could get into, let me ask if I could pay cash close quickly, right? But here's the other additional questions. If we can agree on a price and accept responsibility for future repairs, would you consider a lease purchase or seller financing? Some people may not even know what that means. And if they don't, and they still appear, hey, this could be a good deal, obviously, let's go look at the property. So I can come up here, schedule a time to actually go view this property. Viewing the property is not just going through an inspection checklist. Viewing the property is about building a relationship. That is the key to the business. Remember, I talk about marketing? It's either what we send to people, what the marketing, the content is on those pieces, or it's what comes out of our mouth. But step 4 is really where all the magic happens. Let me go to comparables here. So, the very first thing, and this is really getting into the number side of it, right? So, I've already ran the comps, I've already done this, but I want to share with you what I'm doing. When I look at comps, and sometimes this could be tricky, it's very rare you'd have a perfect comp, very rare. Or I would say the most important thing, you're going to see the subject property across in the gray, dark gray. It is the square footage of the subject property. It says 1607. That is the most important number I want you to look at when you first run comps. Every real estate transaction is based off cost per square foot. Square footage is the number one thing that I look. So I'm visually running my eyes down this column. But if you want to speed that process up, you can go to filter comps and go to your square footage and say it must be between this or that. And this will help you narrow those comps down if you're just getting started. I've already ran the comps, but that's the number one thing that I want you to look for. So this is a 4-bedroom, 2-bath. You're going to see that the first comp is a 3-1, 1,500 square feet. Why would I use that comp? It's got 1 bedroom less, 1 bathroom less. Well, one of the things that I like to do when I'm evaluating comps is to actually go, and this is actually an MLS comp here, is to click this icon, do some more research on that property, and understand what the condition of that particular property was. You're going to find that these properties, somebody added a bedroom, somebody added a bathroom, and I can take that into consideration as I'm running numbers because I know that a 3-1 is an extremely difficult sell. I already know as an investor, I'm going to have to put at minimum another bathroom in. Okay. So I know that it's manageable, but it doesn't follow the strict rule of saying it has to have this many bedrooms or this many baths. Again, my very first concern is the square footage. I can go a little bit under, I'll go a little bit higher. Because in real estate, when you run comps, it's about finding the average cost per square foot. That's what ultimately determines what we call the after repaired value. Amenities can help, obviously. Bedrooms can help, bathrooms can help. This one has an in-ground pool, that one doesn't. Of course, those things matter. But that's when we analyze these comps, you have to pay attention to going and Googling and searching and seeing what this actual property has or doesn't have. Like if you look at the lot size, that may not seem like a big deal, but the third one down's got almost 12,600. It's a little bit different property. Okay. But if you look at the actual sold price, it didn't sell for very high. So it's a 3-1. But if you also look at the year, it was 1958. It's a very small home. So, of course, you could justify the price being, but look at the cost per square foot. All of the lower square foot homes will always have, and especially if, again, it has to be in good condition, mint condition, tip top shape condition. The cost per square foot is always more on a smaller home. If you just looked at a street, just look at if you live on a street, let's say that every house is a different square footage, most likely. So the small house can only justify this cost, right? So it's actually devaluing the home on your street that has the most square footage, while the home with the most square footage is increasing the value of the home with the smallest square feet or the least square feet. It's always trying to find the happy middle. Now, once I do that, I select those properties. It gives me my after repaired value of 437. If I come back up, our estimated value here is 439, but 439 is taking all of it into consideration, several of these properties. But as you can see, several of these properties, they could sell for different prices, which could skew. That's why it's so important to always run comparable sales. This number is the most important number when we're doing everything from this point moving forward. Because if your after repaired value is not calculated correctly, your offer's already wrong. All of your numbers are wrong, which you hear so many times. You could lose money from doing this. So you have to do it right. I'm going to go through making an offer. Taking in consideration, we went to look at this property. I know this is going to sound weird, but I want you to go through the cash offer first. So I don't care if you're the wholesaler, if you're not the wholesaler, just click rehabbing. It's almost irrelevant to me at this point. The after repaired value is going to come over as soon as we calculate that. I'm then going to go into all my expenses, which is acquisition, which would be the cost of buying it, repairs. I threw in 20,000 as an example because I want you to understand how all these numbers work. A hedge expense, always use 10%. It's 10% of the repair expense. It's an added buffer in case you miss something in your inspection. Holding expense, holding time. If I were to buy this property and sell it, I would most likely use an agent. If you don't use an agent, take the commission out. Then when I sell it, there's going to be closing costs and any other costs you could see down here. This gives me back to the top where we can actually add in profits. So at this point of time, all I have done is taken the ARV and backed out all the expenses. Well, if we're going to invest in property, we have to have a profit. So I have to subtract that profit amount to ultimately get to what we call your offer. So this brings me down to 315,000. Now, even if we're not making a cash offer, which I would still make the cash offer because it's going to make your other offers look better, number one. But there's a reason why I do this. Here's the reason. I talk about making multiple offers all the time. Okay, so it's a cash offer, lease option offer, seller finance offer. Not every property you can do all three. Some properties you can only do a cash offer because of the condition, or you can't do the lease option offer because of the condition, or this, that, and so forth. But generally speaking, I like to make three offers. The reason why I do a cash offer is because I know from a sales point, if I go back down here to the 315, I know that would be my cash offer. That's always going to be the lowest price in my three offers that I'm going to make from a sales price point of view. My highest price offer would be a lease option. And right somewhere in the middle of all that, I'll set the price for a seller finance. Now, this is something I have done for years. When you create three offers, the seller looks at cash price. Oh, that's too low. I can't take that much. Then they look at the seller finance offer and say, well, that looks better. Of course, the lease option will always look real good from a sales price point of view, assuming it's in good shape. Somebody could live there right away. Overall, they would make more money seller financing it. So over a period of time, seller financing would look a lot more attractive. Plus, we're getting the deed to the property with the seller finance. So the only reason I want you to do the cash offer, I need to understand that my cash offer's 315. The value of this property is 437 in tip-top shape. I know my seller finance offer needs to be somewhere in the middle of all that, assuming that I can justify the expenses. The number that I picked is 385. This number, there is no magic number to come up with that number. That is just Chris Goff's crazy formula of figuring out where that needs to be. But I'm also going to tell you, I will get a gut feeling of where that price needs to be just by talking with the owner before this step. Because one of the questions that we're going to ask, right, is how much do you want for the property? That immediately tells us what we should be looking for. We need to be maybe around this number. At the end of the day, they could ask for $1 million. They're not going to get $1 million. I still need to run the numbers. It just gives me a ballpark idea of where I need to be. That's all. Now, I know it needs 20 grand in repairs and there's going to be some additional expenses. So I put in the sales price of 385. I put a $10,000 down payment. I'm going to set it at a low interest rate. If the seller comes back and says, no, I need higher, it's all about if you pick the interest rate, how about I'm going to only give you 5 grand down? Or maybe they want 400 for the property. Well, then I'm going to give you 2,000 down. Remember, if the seller picks the terms, you pick the price. If they pick the price, you pick the terms. Just make the numbers work. So you're going to find yourself rearranging these numbers. I'm going to amortize the loan over 30 years, just like a traditional bank would be. Okay. And that's going to keep the monthly payment at its lowest. But I'm going to set what we call a balloon payment. And what that means is I'm going to make payments for up to 5 years. And at the end of the fifth year, that fifth year, whatever balance owed on the property, I have to go refinance that property with a bank, or I could sell the property. Okay. I just need to cash the owner out. Any additional payments you can put in, the property taxes I've entered, and the insurance. Remember, in seller financing, you own the property just as much as if you got financing with Bank of America. You have the deed. That means you're responsible for all maintenance costs and repairs. You're responsible for taxes and insurance. That's an attractive benefit for the owner, that they don't have to manage the property. They don't have to come fix an AC unit because you own the property. Now, if I come back up and just look at the summary of the offer, it's going to, and I really want you to look at the second line here, total interest, or from the bottom, total interest paid for 5 years. Just in interest, the owner would make almost 72,000 if I'm rounding up. Total paid to the seller would be 456. Only paid 385, but because they financed it over a period of time, they're going to end up making a lot more money. So again, you don't have to be a motivated seller to go, hey, instead of selling the house or putting money into the property to sell the house and then move that cash over to a stock, or what am I going to do with the money? Just hold everything right there and you're going to get a return on your investment. Almost $72,000 for 5 years for just saying yes. So the price now almost becomes irrelevant. And again, this is a seller that says, you know what? I don't have to sell that. I don't need the cash today. I didn't even realize I could even do this. That's what this is about. Now, what did it do for us as real estate investors? I didn't have to go to a bank and qualify for a bank loan. I didn't have to put 20% down. And I surely would not pay a 4% interest rate today. We're going to schedule payment $1,790, and that's principal and interest $1,790. You can see it broken down. You're going to see the balance. But look how much principal actually only goes, look how much interest they're making in the beginning of this. And that's what mortgages are all about. So it's going to go down to the 60th month. So 339, if we did this for all of the 5 years. Now keep in mind, you could pay it off at any time. You just got to come to this schedule to see what the balance owed is. I would have to cash the seller out. I can do that by refinancing the property, which is a lot easier to do. Or, and you think about if I refinance this property, could I potentially pull cash out? If it's ultimately worth 437 today, even in 5 years, let's just say it's worth the exact same amount. I only owe 339. You could get the property refinanced, pull tax-free cash out because you don't pay taxes on borrowed money. Then ultimately, I could then keep the property, do something with it, whatever I plan on doing, lease option, rent it out, whatever, however the numbers work, and maybe take some of that tax-free cash and invest it in something else. So this is the beauty of making the offer is that we can see the numbers. You can view this, print this, you can email this to whoever. Okay. But the most important thing is for the owner to see how this is broken down. If they accept this offer and there's no negotiation, I have to understand what my exit strategy is. And that's the beauty of what we see up here is called Deal Pro. So I'm going to go to Deal Pro and I've already analyzed this just to save time. So on the left-hand side is basically the offer of here's how much money it took for me to acquire the property via seller finance with the owner. And this is what we call choosing the buying strategy. Your exit strategy is choosing this step 2 here. In this case, I want to sell or flip because I want to see could I sell or finance a home from an owner and turn around, fix it up, and then sell it? Absolutely. This is a smart way to rehab houses instead of going to the bank. So maybe I want to fix this up and sell it. I'm going to ask for more than it's worth, knowing that I'm not even going to get that price. If I scroll down, I wanted you to see we only made $12,000 on an overpriced home. If I put in 437, that's assuming somebody paid full price, but it may not be that desirable of a house. Buyers are going to negotiate. If I scroll down, I'm 10,000 in the hole. So I know quickly that this would not be an exit strategy per the terms that me and the seller agreed to over here on the left-hand side. Now what I'm going to do is say, okay, well, could I rent this property? Well, let's look at it. So monthly operating income is 12 or 24.95. I can get all this information straight up here. And that's coming directly from Zillow. It's the only Zillow number we pull because they do very good at it. I'm going to put a 0% vacancy and $0 on operating expenses because as we scroll down, my annual cash flow is only $740. And that's per the terms of our agreement. So if I take these numbers, you can see at the very bottom left, my loan payment is $1,790. But also keep in mind, I have to pay taxes and insurance on this property. So my monthly cash flow based on the rent value minus my monthly payment is only $61. So now I'm going, well, daggone, this isn't going to work. I need to move to the next exit strategy. Maybe we lease option this property. Now, I put in a sales price here of 440, which is 3,000 more than today's price. Generally, we only go 12 months with our buyer. Keep in mind, I've got 5 years to cash the seller out. I'm going to put a lease option buyer. How would those numbers work? I can increase the price because 437 is today's price, not a future price. Option payment, I know that I could probably get 20,000 down on this property on a $440,000 house. You think about 10% down is 44,000. I surely can get 20,000. I'm going to put in the rental payment. I'll even give them $100 in monthly credit. So every month that they pay me on time, I will take $100 and subtract it from the balance that they owe. Okay. And if you don't know what I'm talking about with lease options, go watch some of the training videos because it's another great strategy. Now, when I scroll down, I can see my total net profit is 31,000 now. That's sounding a lot better now per the terms that me and the seller agreed to over here. If I were to lease option it, I could potentially make 31,000. Now, the last exit strategy is seller finance it from the owner and then turn around and seller finance it out to another buyer. So remember, we've seller financed it, we've fixed up the property. I'm going to sell it for more than what it's worth, and that's only 445. Okay, because now I'm financing it. I put 1 month to sell. I know I can at minimum get $25,000 down on a $445,000 home. I'm going to do 6% interest, which is more than what I'm paying the owner. And again, you can adjust these numbers. I'm going to amortize it for 30 years, but their balloon payment is going to be due in 4 years because I only have 5 years with the owner and I need to cash them out before the fifth year. So 4 years, they would pay the taxes and insurance, they would own the property. Okay. So that's going to be their payment. We break all this down, and obviously, you guys can go through these numbers. But if I did that, keep in mind for 4 years, I'd make almost 63,000 in profit. It's 140, almost 45% cash on cash. But one of the things that I want to point out to you, just by owner financing it out, I want you to look at this line under the analysis says total payment. This is what we have to pay the owner each month. But by financing it out for 445, they're going to put 25 down, so they owe me 420. The principal interest payment's 25. They have to pay tax and insurance. Now, you see that number? That number is a lot greater. If you go to a bank today, it's going to be around 6%. That's the thing. So this is already kind of a normal deal. It just so happens that number, it is more expensive to buy this house than it is to rent the house. But when you buy the house, you own the house. So I'm actually going to have better cash flow by seller financing this out. Now, if none of these exit strategies work, we paid too much to the owner. That's the key of analyzing these deals and making sure that the numbers are correct. And I promise you, the more that you keep going through this, this is not going to be difficult for you to do. We're figuring out all the math for you just by going through this calculator. And that's the beauty of coming through Deal Pro, is that I can analyze so many different ways, not only from acquiring it, but how to get rid of it and really figure out what would be the best exit strategy for my situation.